So under the current high inflationary environment where interest rates are rising, investors also find themselves in a difficult position where they do not know if they should still be investing in Singapore REITs or should they be looking at alternatives like some of the popular ones are like treasury bills, Singapore savings bonds and so on. So what's this concern that investors have under the current rising rate environment?
Okay, there are two things to actually talk about when it comes to this rising interest rate environment. The first one is what I've mentioned just now.
Yes.
If the interest rate is very high, the REITs management will be very careful about buying properties because, as I mentioned just now, because you need to take out 90% of the earnings as dividends, which means to say that whenever they need to take on any new acquisitions, they will need to borrow money. And at this high interest rate environment, the management is very mindful, and with lesser acquisitions, we mean that the dividend payout is going to slow down.
Yes.
Another thing to look at is because of the high interest rate environment, for those REITs that have a lower percentage of borrowings hedged at fixed rates, they will need to cough out more money to pay for the interest payments, and this will so-called eat into the dividend payout to shareholders.
Correct.
So these are two things.
So it's actually like individuals, right? For our personal finance, sometimes on certain occasions you also take out loans for housing, education. So when the interest expense is increasing, that means we have less money for other consumption, other purposes. So it's very good that sometimes when we cannot understand from the corporate finance point of view, it's good that we look at our personal finance point of view and we try and draw some references
similarities
from certain angles to understand. So for myself, why I still think Singapore REITs investments are attractive is because they allow us to beat inflation. I have this data over here that is published by SGX, which says that on average, Singapore REITs investments actually still provide the highest yield over the STI index and also over the government bonds. And in fact, out of these three asset classes, Singapore REIT is the only asset class that is still able to beat the inflation rate. So isn't beating inflation rate one of the biggest reasons why we get started on investing in the first place?
Yes.
Correct. So but I do understand where investors are coming from. So they are worried about the falling share prices of the REITs and I think this is a matter of perspectives. A lot of times human beings we tend to like to chase after that shiny object and
human nature.
Looking out for how much gains I can actually enjoy in the short term. And in the process, we lose sight of the bigger picture and also our longer term plan. But if we actually take a step back and look at the bigger picture and think longer term, then actually Singapore REITs investments, they generally provide a better chance of helping us to beat inflation.
Yes, most definitely.
Over
if you
the
look
longer
at
term. That's
chart,
right. So I think that's one of the biggest reasons why I find Singapore REITs investments still attractive.
Definitely.
What about you?
Okay, and also interest rates move like sea wave. It will not go down forever like we have seen, in the past couple of years before the COVID struck, and or neither will it remain all the way up for perpetually. So which means to say that there will be one point in time where the Federal Reserve decides enough is enough, and then they will pause the rate hikes, and then the interest rates will start coming down. So when the interest rates start coming down, the REITs management will be able to start acquiring properties again, and this will contribute to the growing revenue of the REITs as well as the dividends that we receive at the end of the day. And this will, just like everything else, fundamentally sound REITs are always the first ones to see recovery than those that are a bit shaky, that you mentioned just now.
I think that's a very good point that you brought up. And I think when we buy the REITs when they are at beaten down prices, then eventually when the recovery sets in, that's when we can enjoy the capital appreciation.
Correct.
And in the meantime, we continue to receive the regular dividends from this REIT. And to add on to your point, I think what can set an investor on the right path is really the investor mindset. Under this environment where share prices are falling, why would we still be interested or willing to buy and invest in Singapore REITs? It's because we need to be able to understand that there's no single business that is totally invisible, that can be totally immune to all forms of changes in the economic environment. That's impossible. But oftentimes, the resilient businesses, they are ones that either they tend to get slightly less impacted because the management is able to react with a plan, or they are also as impacted as other businesses, but they have already accumulated sufficient resources, their earnings, their cash flows along the way for them to actually go through this downturn. So eventually, the main focus should be on whether these REITs, their fundamentals are strong, whether they can still remain relevant and resilient over the longer term. That should be the main focus on the side of investors.
Yes, that's correct.
And speaking on this topic of staying relevant, these days there's also a concern that there are some changing trends in the society, and that may impact the Singapore REITs. So for example, one is this work from home culture,